Hello, everyone. This is Todd Rosenbluth. I'm the head of ETF and mutual fund research at CFRA, and we're excited for you to join us for this upcoming webinar, Thematic Investing and the Reopening Economy. I'm joined, as you'll see on the next slide here, by Jay Jacobs, who's the head of research and strategy for Global X. And I'll show you on the next slide here the agenda we're going to cover. I'm going to give an overview of CFRA, touch on not only the global demand for ETFs, but also specifically thematic ETFs, and highlight a couple of products that we cover that we think are worthy of your attention. Then Jay's going to talk about the structural changes that have happened and accelerated as a result of COVID, and the themes that are likely to benefit, according to Global X's view, and we validated these as well, from the reopening economy. And of course, we'll have some information about risks disclosures, and there'll be an appendix for you to dig into at your leisure when the slides are made available following the presentation. Let's jump on in, if we may. We'll move again to the next slide here. Just an overview. Those of you that have been on our presentations before have seen this stack about the way that we rate ETFs as well as mutual funds using our stock research and how it fits in. We cover individual stocks, we cover sectors and industries, and then our ETF and our mutual fund research fits between that company research and that sector research, offering idea generation. We'll move to the next slide if I can, to just show you the way that we rate ETFs is different than others. Specifically, we name Morningstar here. You're probably familiar with their approach to doing a star rating. Ours is more forward-looking. We're relying on CFRA's fundamental and forensic accounting research to help us give insight as to what's inside the portfolio. We're also leveraging our quantitative research team's machine learning techniques to really bring to you the best of CFRA to understand what's inside the portfolio, understand the risk and reward characteristics, and then marry that with costs. Let's move, if we can, to one more slide here, just to highlight, even though we're doing this with Global X as a speaker here, and we cover their ETFs as well as others, we're an independent research provider. We don't make money on trades. We don't have an asset management arm. Our ratings that you'll see on this presentation and on MarketScope Advisor are available regardless of who we're working with and who we're talking with for these presentations. So we want to make sure you know you're hearing just the truth from us. We'll move to the next slide here. I want to just touch on, obviously you've seen we're having a great year in terms of equity, ETF demand. It's actually been weaker overall in terms of the what we call global, which is non-US specific. So a combination of US and non-US stocks or only international stocks. And you can see the year-to-date flows, there's actually been outflows through the first 9 months of the year, despite how large an asset base the global broad regional funds. You're talking about EFA-based products, emerging market-based products, full total world products that are end up here. Where we're really seeing growth is where we're going to end up touching on this. So CFRA classifies global industry and sector ETFs to be ETFs that are focused on just one sector in particular. Cloud computing ETFs, which is something we'll end up touching on in a moment, would fall into this. And then global factor and thematic ETFs. So factor being more of the smart beta, minimum volatility, quality strategies, and then thematic, where they cross various sectors. And you can see these are smaller parts of the market, but they're really growing. And for good reason. As we'll see on the next slide here, you can see the performance we're just touching on two cloud computing ETFs and then a global technology ETF. CLOU is Global X's ETF. Jay's going to talk about this one. Sky is a first trust ETF. We happen to have a higher rating on CLOU. It isn't just because the performance is different, but also the holdings are different. And we like what's inside CLOU, which is why we're talking about it with you today, both on how it's performed as well as how it's positioned. But this chart really should speak to how you can add value with thematic ETFs, but more importantly, you need to go under the hood and understand what's inside the portfolio, because ETFs that say cloud computing in the name are going to deliver different results based on what's inside the portfolio. If I can move to the next slide here, I'm going to set this up and bring Jay Jacobs, who's, as I mentioned, the head of research and strategy at Global X, Jay, maybe you can just talk about the overall view on thematic investing, and I'll probably come in with a couple of comments as we make it through the presentation. But thanks for joining me.
Sure. Thank you, Todd, and thank you everyone for joining the webinar today. I really appreciate everyone coming in to listen about thematic investing and the reopening economy. If we go to the next slide, we can dive right into it. So first and foremost, Global X, we are an ETF issuer based out of New York, although like many of you, we're kind of based all over the country at this point, working from home and leveraging some of the technologies that we'll talk about today that are enabling not just the stay-at-home economy, but the new stage of the recovery, the reopening economy. If you go to the next slide, what we want to focus on for the first part of today's presentation are the structural changes that are accelerating during this pandemic. So what we're really talking about here is evaluating the markets through a thematic lens. There's a lot of different ways to think about the markets. We could look at valuations, we could look at macro factors like monetary and fiscal policy, we could look at valuations and volatility. But today we're going to look at it through a thematic lens. And what I mean by that is that thematic investing is a forward-looking investment approach that refers to the process of identifying powerful macro-level trends and the companies that stand to benefit from the materialization of those trends. So what we're looking for is, what are the long-term structural trends that existed prior to COVID-19 that have been accelerated by the unique, unprecedented environment, and how that might set up those themes going forward. This is not designed to be short-term. We are not just trying to look for little trades here tactically about what might do well in the next couple of months. We're really looking out many decades of how some of the unprecedented challenges and that we're facing today might create opportunities in unique structural changes across the economy. So if we go to the next slide, you'll see that we have about 20 thematic, about 19 different themes, 20 thematic ETFs that we've identified over the last few years since we started doing thematic investing back in 2010, covering a range of different areas, everything from disruptive technologies to changing consumer habits and demographics, as well as a changing relationship with the physical environment. So before we dig into a few of these themes and how they've been accelerated by the recent environment, I want to show just briefly kind of how we think about thematic investing and how we've arrived at those 20 ETFs you see there. The first thing is we evaluate these themes based off of conviction. So do we believe that these themes are going to have a disruptive impact on the global economy? We look at things like, how large is the total addressable market? How much of that has already been addressed? What if it's a technology? What's the state of the technology? Are there other dependencies or technologies that needed to be developed for this technology to fully emerge? Is there a path to profitability? We're looking at all these different things around the theme to understand how likely it is to play out the way we expect it to. So if we have high conviction in a theme, the next thing we look at is investability. This is very important in the ETF structure because you must invest in publicly traded companies. We're really looking for 20 or more publicly traded equities that are pure play in nature, meaning actually getting really good exposure to the theme that we're trying to get exposure to. And then lastly, what we look at is time frame. So as I mentioned, even though we're looking at COVID-19, which hopefully we can move past as soon as possible, this is not tactical investing. This is not short-term trades. We're looking for long-term structural changes. Now, with that being said, as we'll talk about later in this presentation, there are unique cases of very disrupted environments that tend to either accelerate or de-accelerate the adoption of certain themes. And what we're going to see is that COVID-19 is really a massive accelerator for some of these themes. So when we look at conviction, investability, and time frame, that's how we've ended up with the roughly 20 themes that we have on the right-hand side of the screen, of a universe of about 70 themes that we've considered over the last few years for as potential themes.
So Jay, if I can just jump in, you mentioned 20 out of roughly 70 or so. What are some things that perhaps you guys have passed on that you don't think fits in well from an ETF perspective based on these three subcategories?
Yeah, it's a great question. So we've seen themes fail at any point with conviction, investability, or time frame. In the conviction space, Some themes just maybe aren't ready. They're too early of a technology, and we're uncertain how it might emerge going forward. So one theme we've had our eye on, but we kind of have maybe a yellow light, and we've been a little bit unconvinced thus far, is virtual and augmented reality. We've seen Oculus Rift headsets that are kind of fun. People play with them for 20 minutes. They start to feel a little sick and they put it down, and they don't tend to use it very often going forward. So it's a technology that has a lot of promise, but we're not sure it's ready yet from a conviction perspective. From an investability perspective, one of the themes that we think is very powerful, but just not very investable at this time through publicly traded equities, is blockchain. There's a lot of companies that are really more in the venture capital space. They just haven't IPO'd yet. So if you're trying to construct a portfolio of blockchain companies through the public equity markets, you tend to end up with very dilute exposure to any sort of blockchain, often representing a very small fraction of the revenues that are being generated by those companies. So there's plenty of themes that we have our eye on. It's very rare that we ever kind of completely give a red light to a theme. It just usually ends up on kind of a watch list as we wait to see either the technology evolve or the public equity markets evolve to provide more exposure to it. Going to the next slide, where are we today? We believe there's 4 stages to the COVID-19 pandemic, and I'm sure you've heard many of these terms before, but I like to lay it out in this slide. We have the pre-COVID economy at the beginning of this year, when everything seemed to be very much localized in China, and we were much more focused on the upcoming election this year and the U.S.-China trade deal and other more, just other topics besides COVID-19. Obviously, that changed very quickly in March as we entered into the stay-at-home economy, when global lockdown orders and city and statewide lockdown orders forced everyone into their homes, where we rapidly learned how to adapt to not just working from home, but entertainment from home and socializing from home as well. But now we find ourselves in the reopening economy, sandwiched in between that stay-at-home economy where we were stuck at home and the new normal economy, which is essentially the world that we will enter into after COVID-19. And I think there's an important distinction to make here, which is that the new normal economy is not a return to the pre-COVID economy. There's going to be new rules, new policies and procedures, new ways of thinking about global pandemics, potentially massive changes to how we work and how we live and how we operate a healthcare system. So right now we're in the middle. We don't know what the new normal economy will totally look like, but we're trying to peek our heads out of the stay-at-home economy. We've really been attempting this since the beginning of July, when we started to see COVID infection rates really fall pretty dramatically across the country. But it's a very uncertain and tenuous time. There's new policies being put into place that are changing constantly. We're still arguing over what sort of government fiscal stimulus program should be put in place to support this tenuous environment. And many business owners, employees, students are still very unsure about how safe it is to go outside and what they should be doing to protect themselves and their families. So this is a unique transitory time between maybe more kind of black and white times with the stay-at-home economy and the new normal economy. So looking a little bit backwards again to kind of set up where we are today, it's important to remember what the stay-at-home economy looks like. Now, I'm sure everyone is deeply remembers what the stay-at-home economy was like in the spring as we were all locked at home. But just to contextualize this a little bit, we of course saw the rapid increase in COVID-19 deaths and infections across the United States until it was ultimately started to be brought down through the efficacy of those stay-at-home measures. We saw massive amounts of monetary support from the Fed with almost $3 trillion in balance sheet expansion, the $2 trillion CARES Act, which expired in August. And we saw the massive scaling of testing during that time as well as increases in things like unemployment. So all of this just to remind everyone, to show what an extraordinary and unusual and unprecedented time the stay-at-home economy was, with truly massive efforts to contain this virus and to support the economy through a very unusual time. Now, going forward, so what was the impact of the stay-at-home economy from a thematic perspective? As I mentioned, we're looking at everything through a thematic lens. So, of course, monetary and fiscal policy was massive. The stay-at-home economy, locking everyone in their houses, was a huge disruption to people's days. But what did that mean for certain themes? Well, what we saw was that a lot of different thematic, a lot of different themes saw a massive amount of acceleration through the stay-at-home economy. This happened from two different dimensions. On one hand, we saw many different people and companies adopting technologies at a faster rate than they adopted them before. So if you were working at a company that suddenly couldn't travel to meet with clients or customers, very quickly you saw those companies signed up for Zoom or other video conferencing software to be able to facilitate those conversations while people work from home. Now, many of these companies were likely to get Zoom at some point or some competitor to it. But because of the stay-at-home economy, we saw that this was accelerated faster, meaning as soon as people were at home, you saw massive acceleration in the signups for this technology. Now, the other dimension where we saw the acceleration of some of these themes was in the adoption curve scaling upwards, meaning that the total addressable market for some of these themes expanded as well. More people were being pulled into these markets than were originally expected. A good example of this is in the e-commerce space, where many e-commerce companies simply, don't really try to target the silent generation, people who might be 75, 80, 85 years old, to use their services. But of course, this is a very vulnerable group to COVID-19. Seniors in particular have been very careful about staying inside. And suddenly this generation became quite fluent in using online ordering and e-commerce platforms to order food, to order goods to their houses, to order medicine. So not only did we see people who were likely to adopt these technologies adopt them faster than they otherwise would have because of COVID-19, but we also saw people who were never considered to be customers of these technologies suddenly becoming customers overnight. So what did this mean? This means there was a massive acceleration in the adoption of some of these technologies, showing that COVID-19 was truly an accelerant for some of these disruptive themes. Now, we see this in a few different themes that I'll highlight quickly here. Cloud computing, while the S&P 500 saw revenues tank in Q1 and Q2, we saw cloud computing revenues really surge year over year. SaaS sales up over almost 10% in Q1, up again almost 5% in Q2, compared to a quickly shrinking revenue base for the S&P 500. If we go to the next slide, we saw that e-commerce continued to gain market share. So e-commerce started growing really quickly during the stay-at-home economy, jumping from about 11.5. E-commerce jumped from about 11.5% of total retail sales to almost beyond 15% of total retail sales during the COVID-19 environment. So again, another theme accelerating very quickly during that time frame. And then on the next slide, we also see that video game sales surged almost 25% in Q2 as well, as another theme as people were looking to entertain themselves from home, looking to have social interactions with friends, but not in person. Gaming was really well positioned during that stay-at-home economy as well. So I think an important question that many people are probably asking at this point is, the acceleration that we saw in cloud computing, in e-commerce, in video games and esports, and many of the changes we saw in the economy during that very unique period during the stay-at-home economy, how likely are those going to continue going forward? Were those just flash in the pan changes because people had to adapt to a very strange environment? Or were those setting off structural changes that are likely to continue beyond the stay-at-home economy, through the reopening economy, and into the new normal? Well, I would argue that a lot of these changes are likely permanent in nature. On the left-hand side, we see preferences have changed. The millennial generation is rethinking how they shop at home, how they exercise at home, how they're using mobile payments and video calling. So because a lot of people adopted technology during the stay-at-home economy that they maybe otherwise would have been slower to adopt or never to adopt, they're developing these new preferences and these new habits in a much faster way than we would normally organically see under normal circumstances. So those preferences have changed and are unlikely to reverse going forward. We've also seen permanent changes to the economy in certain sectors. 26 retail bankruptcies in 2020 with famous names like Neiman Marcus and J.C. Penney, to name a few. These companies are brands that are maybe unlikely to continue going forward, resulting in permanent job losses, permanent removal of retail space in certain cities. The type of destruction that you see from these bankruptcies is likely to be permanent as well, as these companies are unlikely to, many of these companies are unlikely to really revive themselves. And that's having a permanent impact on the jobs market, with many of the jobs from these permanently affected sectors like retail, like travel and hospitality, not just resulting in short-term unemployment, but likely resulting in a growing amount of permanent unemployment. So these changes to the economy are increasingly looking like not just short-term adjustments to a unique environment, but really setting in motion permanent changes that are likely to carry forward indefinitely. So all of this was kind of looking back at the disruptive changes that we saw during the stay-at-home economy. And of course, that is not where we are now. We are in the reopening economy, that tenuous period between the stay-at-home timeframe and the new normal economy, which of course we're hoping to get to sooner rather than later. So what does the reopening economy look like? First of all, we have new COVID prevention techniques coming into place, compulsory mask wearing in most public spaces. We're seeing our temperatures being checked, social distancing being enforced. From a government perspective, we have actually not seen much in continuing to support the economy during this period. There's been a lot of preference to try to spur reopening faster and therefore not need as much government support. We've seen the Fed's balance sheet basically be unchanged during this time frame versus the stay-at-home economy. From fiscal support, we saw the Lost Wages Act implemented, but there's been no major package passed yet to really supplant the CARES Act. And frankly, we're seeing a pretty stable amount of testing per day and infections per day during the reopening economy as well. So that's from a macro perspective, but from the more thematic perspective, there's a few things to consider as well. COVID-19 is not yet eliminated. We're continuing to see it flare up here and there. We have those new rules regarding social distancing, hygiene, and mask wearing that, just people are still trying to get used to. Companies and people are generally risk adverse. So even though there might be a desire at a macro level to reopen the economy faster, a lot of people don't necessarily want to be the first ones to test things out, going back into the office or going back into stores. The travel bans and compulsory quarantines are still very much in effect. There's still very few countries you can go to as an American citizen, and some states still have mandatory quarantines if you're coming from out of state. And a lot of this is building on itself, meaning that uncertainty in certain sectors are creating uncertainty in other sectors. The uncertainty around reopenings in schools are continuing uncertainty around reopening in businesses, because if parents have to be at home looking after their kids, it's very hard to make them go into the office. So many of these things are correlated in ways that are making reopening more difficult than originally anticipated. So altogether, we think the reopening economy is still very much uncertain. It's a non-linear process, meaning we're not simply making a little bit of progress each day towards the new normal economy. In fact, oftentimes we're taking 2 steps forward, letting people back into offices or opening schools, and then taking 1 step back as there's a new COVID outbreak and we have to shut things down again. And what it really means is that during this environment, there's an emphasis on safety and flexibility. The companies that are ensuring people's safety during this tenuous time, we think are very well positioned. And companies that are facilitating flexibility, because we don't know if people are going to be in schools or at home or in their offices or at home, are likely to be very well positioned as well. And that's kind of our overarching theme for the reopening economy: safety and flexibility. And we're going to highlight a few themes that we think are very well positioned under that kind of macro theme to provide safety and flexibility to people in the United States.
Jay, before you get there and before we move off of this slide, you do note here the travel bans and compulsory quarantine still in effect. I think it's just worth highlighting, and I'd love your take on this. I know it's not your ETF, but we saw airline ETFs like JETS be extremely popular earlier in the year as a potential reopening and recovery in advance for that. I don't think Global X has a ETF that's directly tied to hotels or travel, but wondering if you can just add your take on that from a research perspective.
Sure. Well, our perspective is that what some people have been talking about as the reopening trade, effectively buying airlines or buying hotels, is not the same way that we define reopening, because buying airplanes and buying hotels is not about safety and flexibility. That is about believing that we're going to get back to the pre-COVID-19 environment, that suddenly, people are going to be traveling at the same levels that they were before. Business travel and travel for pleasure or vacation is going to totally normalize. And we don't see that being the case. The new normal economy that we're going to be entering into probably at some point during 2021 is not the same thing as the December 2019 economy. People's preferences have changed, policies have changed, and the way people leverage technology has changed. If you look at Boeing, for example, Boeing came out with their decade-long forecast for airline sales, and they've reduced those forecasts by about 11%. And Boeing has every incentive to be pretty conservative about reducing their expectations for airline sales. They want to show strength. They want to show that airlines are going to be just as relevant as they were in the 2010s as they will be in the 2020s, but they're revising their own forecasts. So that's showing that truly we are entering into a new normal economy that does not look like the period we were in before COVID-19. So therefore, the reopening trade should not be about betting on going back to normalcy. There's going to be a new normal. And therefore, that's the big distinction between how we're thinking about it and how maybe kind of the broader market is thinking about it, is that reopening is not about going back to normal. Reopening is about this very uncertain, careful environment where we're trying to facilitate the restarting of an economy, not just in the United States, but around the world, while trying to protect people from a virus that is very much still in play. So that's a very different subset of companies than travel and hospitality. And we'll talk about a few of those in the next few slides.
Okay, I'll let you move forward. Thanks.
All right, which themes stand to benefit from the reopening economy? So the first theme that we'll talk about today is cloud computing. Interestingly, this is one of the themes that we've already highlighted. So you've seen that cloud computing played a very central role in the stay-at-home economy. It's going to continue to play a very central role in the reopening economy for some reasons that we'll talk about. And we're also going to talk about telemedicine and digital health in the healthcare space, an early theme that we see gaining prominence during this reopening phase as well. So if we go to the next slide. Cloud computing, many of you, I believe, are going to be familiar with cloud computing. We've all got a crash course on cloud computing over the last few months. It's about the on-demand availability of shared computing resources that can be storing data in the cloud, accessing computing power from the cloud, or more likely accessing software and services through the cloud, like video conferencing, communications, client relationship management systems. You name it. We've all very quickly learned during the stay-at-home economy how we don't have to go into the office to necessarily access our files or communicate with team members or clients. So on the next slide, you can see the cloud computing growth has already been occurring very quickly during the stay-at-home economy. We can look at it through average data usage accelerating very quickly in Q1 and Q2. Upstream data traffic growth. This is just basically people using their computers more at home, driving more data traffic because they're not inside of their offices. Of course, this led to very strong revenue growth in both Q1 and Q2 for cloud computing companies as well. So this is not a theme that is coming out of nowhere. We've seen it. Well, first of all, it's a theme that's been underway for many years, but we've seen it already start to accelerate during the stay-at-home economy. But if we go to the next slide, what we'll see is that we're still not out of the woods yet. People are likely to continue working from home, not just over the next few months, but likely this is a structural shift that's going to continue for a very long time. On the left-hand side, you can see very large companies, Google, Amazon's corporate offices, Uber's corporate offices, showing that they're going to be allowing their workers to remain working from home through a good portion of 2021. But even more importantly, on the right-hand side, Facebook, Twitter, Square, Slack, Shopify, huge employers are also saying that they're going to allow people to work from home indefinitely, that they're never going to force these employees to go back into the offices. There's actually more companies added to this list recently, Dropbox and Microsoft, two more technology companies that have told employees, you do not have to return to our corporate offices. So this is clearly showing that there's already a structural shift underway, that our work from home experiment from March through today is going to become much more permanent. That's coming from the employer perspective. From the employee perspective, you can see that people's preferences have changed as well. So before COVID, roughly 14% of employees said they would be happy working from home 3 days or more per week. That's gone from 14% to 40% since COVID-19. So suddenly, rapid shifting preferences for employees who are happy to skip the commute and happy to work from home rather than going into corporate offices. So what does that mean for cloud computing companies? That means that these video conferencing solutions, these software as a service solutions that are being delivered over the cloud simply can't be fired. If you are CFRA and you're using video conferencing technology, or you're Global X and you're using video conferencing technology, it's going to be very hard to reduce your spend with those companies in the coming years if you continue to have employees working from home, because companies are happy to let people work from home and maybe reduce their real estate footprint, and the employees are happy to work from home because they actually enjoy doing so many days a week. So what does this mean for cloud computing companies over the next few years? Because we've obviously seen very strong performance and strong revenue growth this year already. The biggest thing that we're looking forward to, actually, just go back one slide. What we're looking forward to is a huge expansion in revenue and earnings growth for cloud computing companies. Why is this going to be the case? Well, in 2020, what we saw was a lot of cloud computing companies really seized this unique environment to try to get on as many users' computers as possible. If you were Zoom, you were just trying to get on you were trying to get as many users as possible, grow like crazy, give away 45 minutes for free, have reduced pricing plans for companies so that they learn how to adopt Zoom, and especially in a hard economic environment, not letting costs be a prohibitive element in adopting this cloud technology. But what does it mean going forward? Well, if you've used Zoom for a year and everyone on your team is comfortable with Zoom and your clients are comfortable with Zoom, you're probably unlikely to fire Zoom. You're unlikely to transition to a competing cloud computing service or get rid of it altogether. That's going to give cloud computing companies massive pricing power in 2021 and 2022. We're seeing estimates for revenue growth be really surging in those years, as what's likely to happen is these companies are going to really increase rates very quickly on their customer base. And there's frankly very little customers can do about it. So that's from the revenue side. From the earnings side, cloud computing companies effectively have fixed costs because they develop the software once and they can distribute it to as many clients as possible. So if you increase the cost or the subscription price of your service, that's very accretive to your earnings, and we expect to see massive margin expansion in cloud computing companies as they increase their prices and effectively pocket that as earnings going forward. So we see that as very positive in the cloud computing space. This theme is nowhere near being over from our perspective, as people are going to continue to work from home, and cloud computing companies are going to have massive pricing power over their customers going forward. So the next theme we'll talk about is telemedicine and digital health. Telemedicine is effectively receiving medical care remotely. So rather than driving to your doctor's office and seeing them in person, you can chat via video conference with your doctor, tell them your symptoms, get a prescription refilled, maybe have a diagnosis all over the phone, from the convenience and from the safety of your own home. Beyond that, there's a much bigger theme of a general transition to digital health that includes not just telemedicine, but effectively using connected healthcare devices, applying more analytics to healthcare through the collection of through the collection of data and digitalizing it, as well as greater administration digitalization in hospitals as well. So overall, how can we apply digital technologies to the healthcare space to make it more efficient, convenient, and safe? This is a space that we expect to see growing very quickly. We already expected to see it growing very quickly before COVID-19, but if you look at the next slide, you can see that we saw a massive surge in telemedicine just over the last few months. It's kind of interesting, in the healthcare space, you see some of the most advanced technologies being applied on a daily basis, whether that's robots performing surgery, whether that's using genomics to develop customized drug solutions for individuals. But in a lot of ways, the healthcare system is still very old. The fact that it's still very much required to go see your doctor to get a prescription refilled is a bit antiquated when you could easily hop on the telemedicine call with your doctor, talk for 10 minutes and get that prescription refilled. Or the fact that a lot of data that the doctor is collecting about you and your symptoms is being entered into a computer, maybe being stored by your healthcare provider, probably not being combined with other healthcare providers to find other people with similar symptoms as you, and very unlikely to be using artificial intelligence to look across all of those different patients to try to understand how there might be better treatments and cures going forward. So what we're seeing is that general trend of trying to digitalize healthcare to leverage these technologies much better for better safety and more efficiency in the healthcare system. So on the left-hand side, you can see the telemedicine surge during COVID-19. Just the desire to not go into hospitals or clinics during a very dangerous time is what really spurred this massive adoption of a new technology very quickly for a sector that tends to be pretty slow to adopt some of these new technologies. But we're also seeing digital transformation happening much more broadly beyond just telemedicine, basically doing data analytics on patients and their symptoms on a much more regular basis. So if you go to the next slide, this is a massive addressable market. One of the things that has really held this back in recent years is not the state of the technology. The technology works. We can all do video conference. It can be secured and meet HIPAA guidelines. The challenge has been that healthcare providers have been reluctant to introduce this technology. They don't know how to bill for it. They don't know how to train doctors how to use it, patients how to use it. But because of the COVID-19 environment and the reopening economy, where people are still very uncertain about going back to hospitals, people want to stay at home. They don't want to be exposed to germs if they don't need to be. We're essentially getting a crash course on telemedicine, just like we got a crash course on cloud computing and working from home. So telemedicine is essentially the work from home for the healthcare sector that has been set in motion because of COVID-19, and we think is going to continue going forward for many years, as it's really a more convenient, safer, and more efficient mechanism of providing healthcare to people. So the key takeaways from today's webinar, we did see structural changes accelerate during the stay-at-home economy, from e-commerce to video games and esports and cloud computing, as people adopted technologies faster and the total addressable market increased as more people got pulled into these disruptive technologies. In the reopening economy, we think the general theme is around flexibility and safety. As governments and businesses try to reopen in different parts of the world, we're trying to do so in a safe manner that is allowing for economic growth, but not endangering people. And we think that the parts of the economy and the sectors that are going to be really benefiting from this unique environment are those that are providing safety and flexibility to people. And two that really are top of mind are cloud computing, which is facilitating this massive shift towards permanent work from home, as well as telemedicine, the work from home for healthcare, allowing people to receive not just medical advice, but also digital monitoring of their health remotely as well.
Thanks, Jay. Well, I'm sorry, no, please continue. Apologies.
No problem. I was just going to remind everyone, if you're interested in these topics, this was quick going through these different themes. There's a few more pieces of research we've put out on these topics. We're constantly putting out research on thematic investing, as well as topics like cloud computing and telemedicine. So if you enjoyed what you listened to today, please visit our website at globalxetfs.com/research for more information.
Thanks, Jay. I'm going to put the call out there. We've actually gotten a couple of questions already, but encourage folks in the time permitting to submit questions using the Q&A feature on the GoToWebinar. I would highlight, so obviously we at CFRA are rating the ETFs in part based on what's inside. People probably are familiar with the ETF we're talking about that Global X offers, CLOU, and that's one of the two ETFs I highlighted earlier. It's one of 4 or 5 cloud computing ETFs. Global X does have a telemedicine ETF. I love these tickers of thematic ETFs. It's EDOC, EDOC. And I highlighted one because we cover it. We have a 4-star rating on it. But also for folks that are coming here just to get investment ideas and not necessarily to use ETFs, although we encourage it, you might want to know what's inside it. It holds companies like Viva Systems, Tandem Diabetes, Agilent Technologies, Dexcom. These are all stocks that we at CFRA are rating, and that's how we're helping to drive the overall rating. But Jay, I guess a question that came in here, highlighting just EDOC launched this year, CLOU launched also recently. We are rating this at CFRA despite it being less than 3 years old. Money has gone into these products despite it being less than 3 years old. But maybe you could just address what you're hearing from advisors regarding the time frame it's been to market, and I guess what's resonating with them.
Yeah, it's a good question. So I think the challenge with I think the reason why these products have been successful in a pretty short period of time is that historically people have looked towards sector investing or industry investing to try to get this kind of thematic exposure. I'm interested in disruptive technology. I think disruptive technology is going to play a big role in the economy going forward, so I'm going to buy the tech sector ETF. But the reality is there's a lot of companies and tech sector ETFs and communication services ETFs that are not that disruptive. There's companies that make printers. There's companies that are old school telecom companies in communications. So when we see something like COVID-19 having a very specific disruptive impact and accelerating certain trends, it's not necessarily happening as broadly as at the sector level. It's often happening in a much more nuanced and niche industry. So when we look at something like CLOU or Cloud Computing ETF or EDOC, our telemedicine and digital health ETF being successful, I think it's because people are really looking for those narrowly focused exposures to benefit from these structural changes that are happening. It's these companies tend to be pretty unique. They're global in nature. They can come from a variety of different sectors. So simply just using, the NASDAQ 100 or using, XLK to try to get that exposure, you're really missing out on the majority of the opportunity set for cloud computing or telemedicine.
So that brings me to another question that we got in terms of how we, and I'll welcome your input on this, of how investors are and should be using thematic ETFs as part of a broader portfolio. And I know you've got colleagues that are running model portfolios. What we're finding is advisors are using this as either as a replacement for their healthcare exposure or their technology exposure, or as a complement, as you mentioned, to be a little bit more targeted. But you could have a core of S&P 500 or Russell 1000 U.S. equity exposure, and then complement that with, because you already have technology and healthcare as the two largest sectors, could you have to have more of a thematic long-term approach with a couple of these themes? Is that what you're hearing as well from clients?
Yeah, that's very consistent with what we're hearing and what we're advising clients is, of course, people are going to have that core portion of their portfolio with, a broad equity tracking fund like the S&P 500 or Russell 1000. But we are increasingly seeing people carve out a portion of their portfolio, a satellite portion, and calling it a thematic bucket, an aggressive growth bucket, an opportunistic bucket, where they might put in a few different themes. If you're in a 60-40 equity bond portfolio, people are carving out 5-10% of that portfolio and making it that thematic equity bucket, and maybe putting in 3 or 4 themes. And like you said, one of the things we like to see is diversification across themes. So by getting exposure to telemedicine, you're really getting kind of exposure to disruption in healthcare. Whereas in cloud computing, you're getting disruption to the more traditional IT sector. We see people complement that with fintech and getting exposure to financials disruption, or putting in infrastructure fund, looking at changes in the regulatory environment and fiscal spending. So thinking about segmenting thematic as its own bucket, I think makes a lot of sense, because these are really long-term but frankly more volatile investments. And also getting diversification across a few themes makes sense, so that just classically not putting too many eggs in one basket.
So we'll do one more question that came in that I think is also appropriate, and maybe just as a clarification, and apologies for the background noise from my work from home environment to the audience. So the question just in terms of, are these actively managed or index-based ETFs? Because there are some actively managed thematic ETFs that are out there. Obviously, Jay, I'll let you answer that, and how there's a blend of that from the research effort.
Exactly. So all of our themes are index-based, passively managed ETFs. However, I would say that there's a lot of research and development that goes into developing these ETFs. So we can spend anywhere from 6 months to a year developing a custom index that's really designed to, very accurately target these themes. There's no S&P 500 of telemedicine. There's no NASDAQ 100 of cloud computing. So a lot of these indexes have to be built from the ground up. That's where the expertise of Global X comes in. We've been doing thematic investing for 10 years, so we have a lot of experience constructing these indexes with an index provider to make sure they're really accurately targeting the theme. But we do believe in a passive approach to thematic investing, because when we look at these themes like telemedicine and cloud computing, and we access them through an index fund, what we're trying to do is bet on the theme itself, not the individual winners within those themes. We do think it's difficult within a lot of these emerging themes to identify who the winners and losers will be. Oftentimes it's still very early on. We see consolidation, we see bankruptcies, we see IPOs, and our preference is to try to get broad exposure to all the companies that are really critical to the theme, betting on a rising tide lifting all ships within the theme, rather than trying to bet on the individual names that may or may not win over the next 10 or 20 years.
Great. Thanks, Jay. And thanks, everybody, for the questions that you submitted. I'll move us to the next slide, which is to highlight the upcoming webinar that we have. We're doing another one next week. There's a lot of great ETF content that hopefully you're seeing on MarketScope Advisor, and we've gotten encouragement from you, our clients, to be able to bring the asset managers themselves to you. So we're going to be talking about ESG and actually actively managed ESG strategies, working with Purview Investments that launched an ETF this year. As mentioned, we cover ETFs that have come to market within the last 3 years. So it'll be great insight to hear from Linda Zhang and Jordan Waldrop from TrueMark and Purview, respectively. And then if you're not currently getting our research through MarketScope Advisor, either you're not a client of CFRA or you're getting it in a different way from a feed, there's probably a lot you're missing out. We'd encourage you to take a look at the thematic research. We covered this topic that we did with Jay and the overall thematic world. We talked about, Jay teased about the NASDAQ 100. We talked about the expansion of the Triple Q family this week and dividend strategies. So if you're not using MarketScope Advisor, visit that link and you can get free trial access to be able to do that and get access to our research. With that, I think I want to move us to the next slide, which has another picture of Jay and myself. Sorry you can't see us in person, but Jay, this has been great working with you to educate folks about the reopening economy and a lot of great work that you and the Global X team do. So thank you for joining me, and thank you to the audience for participating.
Thank you, Todd, and thank you everyone for joining as well. I really appreciate the opportunity to speak about thematic investing. And again, please don't hesitate to reach out to our website at globalxetfs.com for more information.
Excellent. So you'll see the appendix later when you have a chance. We don't need to go through it here, but we are putting a survey out there. We'd love your feedback. Let us know what you liked, you didn't like, what you want to hear more from CFRA about. Thank you and have a great rest of your day.